The following is a presentation of TFNN.
All right, welcome everybody. My name is Don Kaufman. Today for the Options Hour. By the way, I'm under Tom's login, Tom Sosnoff's login. I'm actually here in our Chicago offices. Normally I'm broadcasting to you for live from Scottsdale, Arizona, but today I am in Chicago, kind of the headquarters here of ThinkorSwim in the active trader division, of course, of TD Ameritrade. So, shoot in your questions to us. This is the Options Hour, and that's what we're here to do, is get a little bit of Q&A going, so feel free to call in at your leisure. But, hey, get some option questions. In fact, stocks, options, futures, anything really related to the markets right now. Any questions about volatility, I am the guy to answer them. Anyway, give me a call, 877-927-6648. We'll give you kind of a quick recap of the marketplace here and then jump to some callers. But again, give us a call. You know, it's a call-in show. With that, you know what? You can also chat into the questions. I've got multiple monitors set up over here, and I'd be happy to answer your questions, whatever you guys chat in. So I see Obi-Wan, you're in here today, which is good stuff over there. With that, let's take a quick look and review the markets right now. So E-mini S&P 500 futures up 9, NASDAQ futures up almost 21. NASDAQ is quite strong today. Dow futures up about 87. VIX is off about 70 cents today, back to 1875. Oil up 44 cents, has been really kind of hovering at this spot here for the vast majority of the day. We've seen actually some decent overnight action in oil as well. Of course, our bonds are off a bit today. Obviously, bonds off a bit, is pretty much in accordance with what you would normally see when when futures are up. With that, sorry, this is not my normal account, my normal list. I'm like sifting around for different stocks in here. Google up about $5 today. What else we got in here? Apple down $1. It's pretty interesting to see the NASDAQ once again leading the pack over here. I mean, the NASDAQ has just been like the unstoppable force, it seems, in the marketplace as of recently. And again, to see the NASDAQ up 21, well, to me, once again, is a little bit painful. I might be a little bit short NASDAQ right now, which is kind of a painful situation when futures are up 21 day after day. Anyway, though, so I was just talking about with of course, Tom Sosnoff in the last couple of days. I was out on the road with him. We're talking about, what we're seeing, the return of volatility, a little bit of two-way markets here. So we're not just getting that one-way straight up motion, but we've actually seen some, two-sided markets, a little bit of sell-off here and there in the last couple of weeks. The VIX even spiked up a little bit. But once again, the rally has continued. All right, so with that, give us a call, 877-927-6648. The other thing is I'm also taking a lot of questions via email. Most of those email questions came in over the last couple of days, and I'm going to answer some of those live on the air here today as well. But there's nothing more fun than getting you guys calling in with a couple of questions going on here. And again, feel free to chat in your questions too, because it's good stuff. All right. So obviously, taking a look at a chart here of the futures, it's been a pretty wild ride to the upside. I mean, looking at this chart, you never see stuff like this. We're literally straight up, a little bit of volatility, and once again, return to the upside. Of course, again, we saw a little bit of a two-way action here the last couple of weeks in our trading. When I say two-way action, it's just nice to see the market sell off once in a while, especially when you're a contrarian like myself. And to see a spike in volatility is nothing more than an opportunity for option premium sellers like myself. And I'm going to talk a little bit about that as we go along into the show. We're talking about selling premium and so forth. With that, we're going to go to our first caller. But again, you're sitting there listening, call in, 877-927-6648. Let me go to the first caller. It's Joe in Boston on Amazon. Joe, you there?
I am. How are you?
Oh, good. How you doing?
Good. Hey, I was looking at out in May.
Yeah.
At the 190, 195 call spread?
Okay. The 90-95 call spread all the way out to May. Let me open up the May options. 52 days from now. You're looking at buying it or selling it?
I was looking at buying it. I didn't know. It looks like it's about a little over $1.
All right, so this is going to be fun. This is actually the stuff that I absolutely love, kind of explaining on something like this. So you're going out and you're buying the 90-95 spread. And here, I'm actually going to pull this one up. I'm not sure if you're on the screenshot or not.
I'm not.
So the 190-95 spread is trading for about $1.05 right now. What I would actually look at in this spread is, first of all, obviously, the profit potential in here, it's a $5 wide spread. You pay $1 for it. For the most part, you can make $4 on the spread. That's holding it pretty much until expiration, assuming the stock is above 195. Now, what I like to explain in here is, first of all, it's a defined risk trade. So, you know, if all hell breaks loose in this underlying, great, you lose $1, not that big of a deal. But one thing I'm going to kind of core into is simply this. I'm going to change my little information layouts here on ThinkorSwim, come down to options, theoreticals, and Greeks, and pull up delta. And the other information layout I'm going to change over to probability of expiring. So probability of expiring is probability of an option being in the money by 1 penny or more come expiration. And they're showing that the 190s only have about a 22% chance of falling in the money by May expiration. Now, this isn't a bad thing, but the reason this trade is rather inexpensive, okay, the cost of the trade has definitively, okay, gives you the probability of this trade being in the money by expiration. That kind of makes sense? So if you pay $1 for a spread that can make $5, that trade basically has about a 20% probability associated with it. Okay, it's like a 1 in 5 chance, and that's exactly the way the spread is pricing it. So you could be right directionally here and still lose your dollar, obviously, because we've got to have a pretty dramatic up move in Amazon. So have you ever sold out-of-the-money options rather than buy out-of-the-money options?
Yes. The only reason I was going up that high is because that does capture earnings.
Sure.
I'm pretty sure that captures, and it can move a lot on earnings. I'm not saying, no, I haven't. I mean, in terms of you saying sell that option?
Well, no, I'd actually look at, if you're bullish, I'd probably sell an out-of-the-money put spread. But, you know, you're going to pass through earnings, so implied volatility is going to start to slowly creep up. But
right.
If you're going to pass through earnings on here, you still could consider selling an out-of-the-money put spread. I mean, the kind of the inverse, I should say, trade for this, I'm just going to look at like the 60-55 put spread.
Okay.
Let's go sell, for instance, vertical. And I'm not necessarily saying, hey, this is a good trade for you, but this is an interesting play. So selling the 160, buying the 155 puts, selling the put spread, you collect basically, let's say, $1.15, and you're actually absorbing almost $4 of risk on this trade, but the probability is the inverse. The probability of success in this trade is over, 75%.
Okay.
And it's all I'm looking at is from a pure probability perspective. It's neither, right nor wrong. It's if you have a conviction that this stock is going to move up dramatically, your trade's not half bad, but it's so far out of the money. Okay, you could even consider doing something that it'll have a little bit more risk, but it'll have a higher probability. And that is here on Amazon. Of course, you could sell the put spread like I just showed, but you can also buy a slightly in-the-money call spread, because that way you'll actually limit the amount of extrinsic premium you have at risk. And this is not a cheap way, of course, to trade by buying this, but I'll just give you an example here. Let's see if we can find one. Let's look at buy like vertical. Here's a 70-75 spread. Well, this is just just the 70-75 spread. It's a $5 wide spread. You can't make a ton of money on this. You can only make $5, and the spread costs $2.68. But if you take a look where the stock is right now, the stock is at $173 and change. This spread is already in the money by $3.81, and it only costs $2.68.
Right.
It's just it's interesting because when it comes to risk reward, you're risking basically here, basically 260 to be able to make 240. All right. Probability of success is a little bit over 50%. Your trade had a very low probability associated with it. It only had about a 20% probability, but you were risking, $1 to be able to make 4 if we explode to the upside. So everything you do in options is a trade-off. I just like the fact that this one does not, you're not buying any time value here. You're not buying extrinsic premium,
right,
which is always a plus in this kind of situation. So they're all considerations. And again, your spread's not wrong. It's just, for it to pay off, you've got to really, come up hard, fast there, and hit it and hope that earnings really drives this stock through. That's a tough play. Definitely a tough play out there.
Okay,
so any follow-up on that one?
Do you ever use, if you did a put spread for a credit, do you ever use those credits to purchase call spreads?
Yeah, you definitely could. Basically, if you sell a put spread and then turn around and buy a call spread, it basically makes you effectively synthetically long that stock. It's just a synthetic position. And there's nothing wrong with that, but to remember that selling that put spread, so if you sell a put spread for $1, it's a $5 wide put spread, you sell it for $1, you got $4 of risk. Right. If you take that dollar then and purchase a call spread, now all of a sudden you have even more risk. Now you got almost the full $5 at risk. There's nothing wrong with that at all. When you use that particular spread then, that is very similar to buying an in-the-money call spread like I just did, because then you're basically, dollar for dollar at risk with the stock, which is, for the most part, what I did. And I used this little 70-75 spread to give you an example. But ultimately, it's very, very similar in that respect in terms of a risk-reward. It's basically, you can lose $5 or make $5 in what you just mentioned, which is selling a put spread to finance a call spread. I'm doing basically the same thing by buying an in-the-money call spread. I'm risking basically $250 to be able to make about $250 in the trade. Okay. So it's just interesting. Like options, man, there's always more than one way to do it, and nothing is ever wrong. Personally, I like slightly high probability trades. If the trade doesn't have over about a 60-70% probability, I don't really do it. And the reason I don't do them is I'm wrong more often than I'm right, and I can still make money in this market. When you buy out of the money premium, you have to be right, and that's hard. Longer term. But I also think that, hey, if you just want to take a shot, go to town. I'm the first guy to tell you, if you just want to take a shot on this one, kind of like a little flyer that, this stock's going to explode through earnings, then your trade might be the right one for you.
Okay. Thanks, Don.
Yeah. All right. Thanks a lot, Joe.
I take care.
So, great. So, great call to start off the day with. But if you guys are sitting at home right now and you've got nothing better to do, but yet you have option questions, give us a call, 877-927-6648. Again, it's a call-in show. With that, you guys can always chat them in as well. I will repeat your question live on air. Hey, at least chat somewhat. Let me know somebody's listening out here, or give us a call, because it makes it a lot more interesting. Anyway, with that, talk a little bit about the markets, and I always have kind of a theme of every single time I do one of these shows here. I always kind of have a theme to that, and today's theme is about selling premium, and I've talked about this, quite often whenever I do this show about selling premium. We just really kind of hit on it there with the first caller, Joe from Boston, talking about Amazon, but I had a great question, and it was something that was emailed to me. It was actually from David, and he was asking about selling premium, identifying good ETFs to trade, and then he was asking basically about utilizing, which Greeks do I utilize, what's the time frame for selling, spreads, what's the delta of selling the spreads, and how far out, of course, in time do you go? Do you use, spreads that are months and months out, or do you sell spreads that are a little bit closer in? And that's really kind of focusing in on criteria. So I'm going to core into that a little bit as I kind of move along here, and we'll take some callers along the way. So let me kind of jump into this. So with that, you can also give us a call at 877-927-6648. Okay. Let's talk a little bit about just, the trade in general, what selling premium really means. The first thing we'll talk about is, of course, volatility and VIX. Volatility is what definitively prices options. When people think about volatility, I mean, if you go out, to a group of traders and you ask, hey, what's volatility? 9 out of 10 of them, on the retail side say volatility is movement. And I usually, no. That is a definition, but that's not the definition we're looking for. So volatility can't, by definition, be movement. Now, that is a secondary definition, but it can't when it relates to options, because I want you guys to think about this. If you saw the Dow, all right, and I'm mentioning the Dow because a lot of people look at that, but if you mention the Dow, and the Dow basically went up 500 points today. First of all, if the Dow goes up 500 points today, I'm probably going to barf. pretty good chance of it because that's going to hurt my short positions. But if the Dow goes up 500 points today, what happens to implied volatility? Well, the VIX and the market vol drops off. All right, I'll get to why in just a second. So you see volatility contract in an up move. Conversely, if you saw the Dow today sell off, Dow sells off 500 points. Again, I'd be cheering. But if the Dow sells off 500 points, you see volatility absolutely explode. So now the question is why? Why is volatility definitively linked to rallies and sell-offs? Because in the end, what is volatility? Well, volatility, the way that we look at it and what the VIX is the VIX is a measure of the options within the S&P 500. People say, I always ask, well, what price is options? Everybody always raises their hand. They go, Black-Scholes. I go, Black-Scholes does not price options. Black-Scholes is a model to help derive option pricing. Okay, but what are the components that really derive it? In the end, the most integral part of pricing an option, time. So time is a huge factor because somebody's actually chatting in right now. Time is a huge factor, but time is pretty straightforward. Hey, listen, these May options have 52 days left. That's pretty straightforward. But the most definitive factor, in an options pricing, of course, is going to be the implied volatility or its volatility of that option. And in the end, volatility is truly set via supply and demand. So if the market were to rally huge, nobody demands options in a gigantic market rally. All right. So again, nobody says, "Oh man, I gotta have options" when the market's rallying absolutely huge. In fact, a lot of people, when the markets are rallying, will even sell option premium. You sell premium, it creates a little bit of supply, and of course, volatility drops off. Now, if the market tanks, like the Japan news came out, markets really started pushing down hard. What happened to the VIX? The VIX spiked. In fact, one day, which was it last Tuesday? I don't know. Everything's a blur these days. Or it could have been 2 Tuesdays ago. But, about 10 trading days ago, you saw it was 2 Tuesdays ago, sorry. You actually saw the VIX spike up 7 points in within the trading day, and that's because there was a little bit of a panic, and immediately the demand for option premium is extraordinary. So the demand for options, because options is used, or utilized as risk management tools, demand for options increases, and of course everybody goes out there and they try to buy puts as insurance policies against their long positions, ultimately raising up the volatility. So that is where really we start with whenever we talk about premium and premium selling techniques. We always start with volatility and what it really is. Volatility, is a measure of risk, supply and demand on S&P 500 options, and that's really, what the VIX kind of denotes. And, of course, you'll see the VIX is down here about 70 cents in the day back to 1876, which we're definitely at the lower end, once again, of the volatility range. So the lower end of the volatility range typically correlates to the upper end of the market. All right. Not to say, volatility right now is sitting right about 18.75%. That's relatively low. Does it mean it can't go lower? Absolutely not. That volatility can crush all the way down to 12, 13%. And of course, for it to crush down to 12, 13%, you would probably need a pretty decent rally, which we're having right now. So always keep that in mind. Anyway, with that, whenever we talk about premium and premium selling, right, we're really talking about going out and finding option strategies that generate time decay in our favor. And when I say generate time decay, I'm really talking about theta. And theta is the Greek, of course, for decay, and that basically means the daily whittling down of an option's value, and it's inescapable. Whether you buy options, whether you sell options, all right, you will have theta associated with any option trade that you're in. If I go out right now and I buy these 132 calls in, of course, the spiders, what do I really have? Well, I have about $3.06 of premium. All right, this premium that I'm looking at right here is all extrinsic premium because it's time value, because this is an out-of-the-money option. All right, slightly out of the money. It's pretty much the 132s are very close to being at the money here, but this is $3 of extrinsic value or time value. If I were to buy this option, the market were to stay completely and totally flat for 52 days, every single day that passes, of course, is a day against me. I am losing, all right, some of the value of the option as they start to whittle away. So with that, all right, I'll take a brief pause here and say, we're not getting a lot of callers, so you guys should call us, 877-927-6648. I think a lot of the times I just start talking and you guys start listening and you don't call us. Whether you're a first-time caller or multiple caller, give us a call today. So back to the talk over here. If you take a look at these 132 calls, you're paying $3 in premium for them, all right? That's not to say this is not a bad trade, but if the market stays flat, you're going to lose your $3. So ultimately, when we talk about options and option premium selling, what we're really referring to typically is selling out of the money options in some type of a defined risk manner to basically be able to yield that theta or that time decay in our favor. You got to realize that I'm going to stay with this option chain right here, and I know some of you guys are listening in just the radio. Some of you guys can see my screenshot through TFNN.com, but we'll take a look. This is a nice, easy example here. The 134 calls in May. They're 52 days to expiration. If I buy these calls, all right, you buy them for $2. Where do you need the underlying? Well, you need the underlying at 134 plus the $2. Now, that's looking at this trade, worst case scenario. But you got to understand that you need to look at things worst case scenario because it's probably what your account is going to do. So, taking a look at this, the 134 calls trading for $2 is about a 35% chance of these things falling in the money. But there's about a 35% chance, and this is a column I have set up on my screen called probability of expiring. It's probability of an option being in the money by 1 penny or more come expiration. Coming up to 134 doesn't help you, because you need this at 134 plus the $2, which is really 136. There's about a 25% chance that by expiration, that we crest above, of course, by expiration, fall there, by expiration, about 25% chance that we crest above 136. So there's a 25% chance that the 136 calls fall in the money by 1 penny or more come expiration. So keep that in mind when buying option premium. The probability, of it expiring in the money is extremely low. I mean, look at it this way. You have about a 25% chance in this trade of getting your $2 back. And that's a harsh way of looking at it, but it's the reality of how options are priced. So somebody always chimes in and they go, well, how do they figure out those probabilities of expiring? Well, the probability of expiring is derived directly from the implied volatility. And we know that's pretty good, all right? I'm just reading in over here. All right, somebody's actually chiming in here. I love this. Lunchtime in Chicago. That's awesome. It is lunchtime in Chicago right now. I'm missing lunch, and I'm in Chicago. Okay, so give us a call, and we're going to talk a little bit more about probability of expiring here. Wow, it is quiet in the Tiger's Den today. You guys aren't even really chatting in these questions over here, so give us a call, 877-927-6648, and we'll kind of continue on with our discussion here on probability of expiring, the Greeks, and just really overall criteria for entering and exiting trades. But let's take another caller right now. So Gene in West Palm Beach got a question about oil. You there, Gene?
Yes, sir.
Yeah, what do you got?
Before I get on to oil, I've listened to you pretty much every week, whatever, also Tom months ago.
Yeah.
Why are you guys still negative? The trend seems to be up. I know we have a lot of problems in Europe, the wars we're having, in 3 other countries. But, you guys seem to be, in opinion-wise, that we're going to be down substantially or a good percentage within a short period of time.
So we're talking about oil now or just the general markets?
No, your view of the general markets.
Sure. I'm 100% a contrarian. I mean, myself, Tom, and we kind of grew up in the same school of thought. And what a contrarian really is...
I'm a doomsdayer also, but it just seems like the trend is up, and then play the trend and do your options on the negative aspect, but at least you're making something with the market going up.
Oh, I totally agree that you can trade that way. That is not the way that, I would sell premium. Being contrarian, I see much more upside in my own trading when I'm typically against trends. And being against trends doesn't mean like, hey, be a bull when everybody else is a bear, be a bear when everybody else is a bull. But when you start to see markets be, and I've actually got a chart up here of the spiders, which is pretty awesome. When you start to see markets get parabolic with moves, that from, literally, we haven't had many downticks since October. I mean, I can go back even farther here on the chart, that you're right. Would you have been, profitable here? I'm going to go back to an entire year chart, literally since September, okay, actually late August. We haven't had too many downticks. Would you have been profitable being long, since, late August, early September? The answer is absolutely, okay? The way that I look at it, though, there are definitely more up days than down days, but the large down days pay off. Plain and simple. What we saw 2 weeks ago in the down move was enough to basically pay off everything I've lost, to this upside move. And I have to tell you, when you're efficient at selling premium, we're, here to really teach selling out of the money premium. We're not taking a lot of heat on trades. We're doing everything we can to bring in enough time decay to try to keep your head above water while still maintaining a short position. Because we all know sooner or later we will sell off and sell off hard. The question is, it's just when. It's not if it will happen. It's when that sell-off will happen. And, I shouldn't say that I think, a dramatic sell-off is coming. When I say dramatic, if we saw an 8-10% down move in the next few weeks, it wouldn't surprise me. But, being straight up the entire way is kind of surprising. And ultimately, I think that listening to this show, the general public and the general retail clients do very, very well in up markets like this. So we always root for you guys. I mean, we've basically got over 4 million clients, and we're always rooting for our clients out here. In my own trading, though, being contrarian is really kind of where we grew up. I'm not much of a market technician here, and to me, when the market's up, 8 out of 10 days, it, logically makes sense only to take the other side of that and to get short. And that's really an effect of, having traded on the professional side for a period of time there. So I hope that, sheds some light on it, to some degree. But it's not easy being a contrarian. It's more about how to efficiently strategize being a contrarian. It's not like I'm out there selling futures and then getting down on my hands and knees praying, because I'd be killed in an upside move.
What's your feelings as far as oil? Going down, going up?
You know what? Honestly, right now I'm a little bit short oil. I've kept a position on oil for quite a period of time, and rode this up wave. I've actually gotten a little bit short oil, just a little bit, by selling some out of the money premium on it. And the reason I'm doing that is, the whole world's blowing up. In Japan, you got the Mideast in a crisis right now, and oil doesn't give a damn anymore. And all of a sudden, the oil trade is really not in play so much anymore. So I think that 105 is a pretty good area to hover in. The upside will be, at most maybe 107. But yeah, I'm short oil right now, looking for a move back down to about the 95 level on that CL future, which is of course the primary light sweet crude that we track a lot of the times. So. Is that also contrary to what the position you've got on right now?
No, I was going to say I've got an account at TOS, and it's pretty much self-directed, buy, sell, whatever. Do you offer any form of advice service?
You know what? There's no advice really provided by ThinkorSwim. You can always call up our trade desk and bounce ideas off the guys, but ultimately, if you really want true advice, you have to look to some of the ancillary services we have, like Red Option. Red Option is a true advisory service that they'll actually make definitive calls there in terms of direction of the market and really affect advice type trades. So Red Option is also a product that's owned, of course, by ThinkorSwim and TD Ameritrade. Yeah, so I'm going to have to run here. I got a bunch of callers standing by, but
thank you.
It's good to hear from you, Gene, and call back in the near future here.
Will do.
So, yeah, with that, we're going to go directly to another caller. It's Mark in L.A. Question about the VIX. What do you got for us, Mark?
Yeah, I had a couple of questions. One was a VIX and one was a calendar. They're kind of related. You put on a calendar when it's lower VIX or when it's higher VIX? I kind of did one on RIM, and I'm just treading water there. And
so, first of all, calendar spreads are better typically to buy in a low volatility climate. Calendar spreads effectively make you net long volatility. Now, that being said, if you buy a call calendar spread, that kind of defeats the purpose. And the reason is, if RIM were to go up, RIM's implied volatility goes down very slightly, and ultimately that can negatively affect your calendar spread. But if you use the slightly out-of-the-money put calendar, as RIM sells off, its volatility expands, and that actually helps the back-month option within your calendar spread.
Yeah, it was at-the-money put spread, put calendar, and as you know, earnings RIM was down.
Yeah, no, that's okay. That's okay. At the money, hey, that plays, man. That'll definitely play for sure. But always remember that calendar spreads do effectively make you net long volatility. I mean, the effect of volatility in the average account is not going to be too drastic, but it's still getting net long volatility. And in essence, it's more efficient to utilize calendar spreads if you think volatility is low right now, and if you think the markets are going to sell off. Getting long slightly out of the money put calendars can be a nice play. If we do sell off and volatility does expand out, it can't hurt at all to be long a couple out of the money put calendars on there.
And my question about the VIX, I've not bought or sold options in that, but if VIX is low, why couldn't I buy a 70-80 delta call?
All right, so buying an in-the-money call, you want to get purely directional? You know what? When you start buying high delta options, and you're talking about a pure directional trade here, I take it?
Yeah, if it's at a low VIX, it's going to have to go higher eventually, right?
Well, yeah, but if you're buying a deep-in-the-money call, okay, or a deep-in-the-money, so you were saying buying a deep-in-the-money call when the VIX is relatively low? Yeah. Ultimately, I mean, you're buying a deep-in-the-money call. The volatility effect on deep-in-the-money options is really, minuscule. So you get very little volatility because there's very little extrinsic time value on deep-in-the-money options, so vol doesn't really take into effect that much. I mean, the bottom line is if you want to get long or short the S&P 500, the most efficient way to do it is to just buy or sell futures, or you could utilize deep-in-the-money options, to, in effect, synthetically control that stock. And it starts to get a little bit esoteric as I talk about this, but ultimately the easiest way to get long or short, like the S&P, is just to utilize the futures. It's the most effective, most cost-effective from a margin perspective also. Okay. So I hope that helps out a little bit there. But, yeah, in-the-money options, minuscule effect from of course, volatility, on those in-the-money options. So even if you went out and bought deep in-the-money options and you saw vol pop, there's going to be almost no effect to those in-the-money options.
Okay, thank you for giving up your lunch hour for us newbies to answer questions.
No problem. Yeah, and you know what? Missing lunch in Chicago offices here is a big deal. It's good eats here. Anyway, we're going to jump directly to another call. So, hey, nobody called in the beginning, and now everybody's calling in, which is good. The next caller, we got Michael from Denver. Got a question about Rambus, it looks like. You there, Michael?
Yes, I wanted to ask you what you think of selling covered calls on Rambus?
What's funny is I honestly have not looked at Rambus in quite some time now. That's something that used to be in play like years ago, and it hasn't been something that's been on my radar screen. Oh, man. So I haven't looked at this in a long time. First thing I look at over here is the implied volatility. And, I look at the underlying price. We haven't moved much today. Number of shares traded is kind of nominal. It's kind of low, but taking a look over here on the right-hand side of the screen, Rambus is rocking. I'm going to guess that they have earnings coming out before the May expiration. The implied volatility is already jacked up a little bit in May. So keep an eye out for that, for possible earnings coming out over here. With that, covered calls in this underlying, there's a lot of premium to collect here. I would not really suggest that you go out and run out and buy Rambus specifically to sell covered calls. But if you already own the underlying, this is actually a decent underlying to sell covered calls on. Do you already own this thing?
No.
Okay, so if I did not own the underlying, all right, because it's got a decent and high implied volatility, you could, just as efficiently as selling a covered call without ever having to buy the stock, just use vertical spreads. It scares me getting you long a $19 stock. It's a $19.55 stock. Like, unless you think this stock is going to appreciate to the upside, don't get long the stock. If the idea is you just want to sell covered calls, all right, in the end, covered calls is a strategy for people that want to be long the stock. If you just want to sell premium here because it's high volatility, just sell spreads. It's the same thing for the most part as premium selling technique as like a covered call, but you don't have to put up, the $19.55 because, I have no idea. And again, this is not a stock I've looked at in recent years, but I have no idea what their earnings are going to hold. Pre-announcements, post-announcements, there's a lot of risk, obviously, in this underlying, sitting at a 76% volatility in the month of May. Okay. So, have you sold any spreads yet?
No, I haven't. I don't really know that much about them.
So basically, selling a spread, selling a covered call is in effect like you buy the stock and you'd sell like this May, for instance, 22 call, and you collect about $1.20 on it. Okay, it's about a 38 delta call. So for the most part, you bought the stock at $19.55. You sold the May 22 call, all right, and collected about $1. And that's ultimately the covered call. And, of course, then you could sell one the month following that. What a spread basically will allow you to do is I'm just going to right-click over here. Are you watching the screen show right now or no?
No.
All right. That doesn't help me very much. No, I'm just kidding. But for the most part, the spread is you would sell, for instance, the 21 calls and turn around then and buy the 23 calls. Now, you're not collecting a full dollar here. You're only collecting about 50 cents for this $2 wide spread, but you don't have to carry the $19.55 stock. You're just literally selling one option and buying another option against it. All I'm trying to do is get you out of harm's way when it comes to the stock. You got to try to separate in your head premium selling, okay, from covered calls. So covered calls, again, great strategy if you already own the stock or if you want to be long the stock. If you don't really care so much about the stock, you're just more interested in selling stuff, learn everything you can about selling out of the money spreads, because in this case, this could be saving you a lot of capital here. So in this, selling the 121s and buying selling the 21s and buying the 23s, the most you can make is basically 50 cents. The most you can lose is $1.50. But it kept you away from, of course, the absorbent amount of risk of owning those shares of Rambus, especially going through an earnings announcement.
Okay. I'll look into selling out of the money spreads.
Yeah, sounds good. And feel free to give us a call and follow up with any questions you might have here in coming weeks.
All right. Thank you very much.
All right. Thanks a lot, Michael. So, all right, we're going to jump right to another caller here. What's interesting is all these calls are right along the same line with selling premium. And before I grab this next caller, and, he's been standing by for a while, you need to give us a call, 877-927-6648. And options-related questions. Hey, if you got questions about being a contrarian, you got questions about oil, we've had all of them today. We had questions about the VIX, volatility, everything from Rambus over here to the VIX to oil to Amazon. We've answered it. Let's grab the next caller. It's Mike in Lakewood, California. Got a question about RIM. You there, Mike?
Yeah, I'm still here.
Sorry I kept you on hold there for so long.
No, that's all right. No problem at all. I've got some deep in the money puts that I was lucky enough to pick up the day before RIM reported.
Yeah.
So I'm just trying to get an idea what would be a strategy for handling them. I know that I've got 2.5 weeks. There's essentially no premium left because they're about $6 in the money.
Okay. So right now, this is actually really quite an easy position to discuss. You've got 17 days left till April expiration. They are April's. You said 2.5 weeks.
They are April. That's correct. They're 62.5s.
All right, the 62.5. So we're basically 575 at 585 right now. So you are in the money with very little extrinsic premium here. Basically what you got is you got short shares of stock. So for the most part, you're effectively short the stock right now. And the question is, do you think the stock's going to continue down? Be careful with this because when we do have these big sell-offs like this, there tends to be a little bit of bounce back, which is exactly what we're seeing today.
Right.
So we can, of course, pull up like the chart on RIM over here. Ultimately, first thing I ask you is, what's your outlook for the next 2.5 weeks? I mean, your personal outlook. Do you have one for the next 2.5 weeks? You think we're going to bounce back or sell off?
Well, looking at the end of the quarter, I intended to get rid of a third of my position in the next day or two for sure because I'm assuming that there'll be a little bit more sell-off that people won't want to have it in their portfolio. I'm talking about the big funds, obviously.
Sure.
Going into the end of the quarter.
So I actually 100% agree with the idea that you like to stagger into positions and stagger out. So you got 10 contracts on. There's nothing wrong with you unloading 3 contracts, 4 contracts, 5 contracts, at a clip here to basically lessen your risk on the position, and then you've got a free ride on the rest of the contracts left. That's, a great idea. If you think we're going to bounce back up, I mean, today we're back up about 90 cents here in RIM. You think we're going to bounce back any more than this, you might just want to, sell these things and run. Take the money and run. There's nothing wrong with that. You caught this one right. I mean, right on there.
Yeah, I got lucky and with a little skill. So.
Yeah, you know what? I do this all too often, but, I do stupid things like, hey, I keep a profitable trade on only to give back some of the profit. Trades don't typically become that much more profitable, especially when you got this big sell-off move like we have. The other thing is, and I don't have this on my chart right now, but this sell-off, whether you're aware or not, was on pretty extraordinary volume.
Right.
And the reason I mention that is I always think about that because everybody, I'm going to reset this chart so you guys can see the volume here real quick. The reason I mentioned that the volume was absolutely massive, everybody that has puked has already done it.
Okay.
And that's why you got to worry a little bit being short this particular position because all of a sudden volume dropped back off. So we're starting to get back into normal volume ranges. Those that panicked, it happened. I mean, we traded over 50 million shares here when the stock tanked the other day.
No, that's what I call it. I tend to agree with everything exactly you're saying. I wanted to hear somebody else tell me what I'm already thinking. So.
Yeah, no, you know what, man? I still do this on a day-to-day basis, and I'm always talking to guys on our trade desk. I talk to Tom Sosnoff, Steve Quirk, Joe Kinahan, everybody over here when I'm thinking through this stuff, because no matter how many times you do it, listen, if you got out of this position and basically you're short the stock, if you got out of this position and RIM dropped down another couple of dollars more, so be it. But on this particular position, I think that the risk right now for you is that the stock rallies, and I see that as a more apparent risk than this market selling off more on RIM.
Okay, well, great. Do you have another caller, or do you have time for another question?
No, go for it. You got another question? Go for it.
I'm not even sure this is even a strategy, but very quickly, let's say I'm short a stock, and I want to sell puts at the price just below my short position, and then it gets put to me. Can I use that shares that have been put to me to cover my short?
Absolutely. And I'm speaking specifically for ThinkorSwim and TD Ameritrade, but all you have is like an inverted covered call. And listen, if you're short shares and you get the stock put to you, that covers your short shares, and that's all there is to it.
Okay, well, thanks very much. I appreciate your time.
Yeah, thanks for calling in. So, this position here in RIM, obviously a lot of people are talking about RIM in the last couple of days, and I was joking about RIM just earlier today. So I have a BlackBerry through work, and it's I'm attached to that BlackBerry pretty much. About 10 hours a day as emails start to pour in. There are emails for work and so forth. And so about 10 hours a day I'm attached to that. But I also have an iPhone 4, and that's the one I'm playing with right now. So there's no question that the iPhone or one of the Android platforms are much better toys than a BlackBerry is. If I didn't have to have that stupid thing for work, I wouldn't have it. But and you saw that here represented a little bit in I think in this sell-off here in terms of their market share, giving it up to, of course, to both Google and Apple. Anyway, with that, that's just a little anecdotal story there on RIM, and that's my own bias. I like Apple products. I'm a big Mac fan. That being said, I'd also like to see Apple tank right now. It's about time. I mean, at the $350 range, I don't care whether I've got an iPad, I have an iPhone, I do have a Mac at home. I got my Mac issued underwear on right now. That still does not make me want to buy this stock. Steve Jobs would be the greatest innovator, probably. He'll go down in history probably as one of the greatest innovators of this particular era. I still don't think it justifies a $350 stock, price at this current time. So that entire NASDAQ here is pretty out of control. In fact, I was also thinking about, I came into our Chicago offices today, and I'll grab a couple more questions here in just a moment, but I came into our Chicago offices, and so ThinkorSwim was a small startup company. We moved into this office about 4 years ago. We were the small guy on the street, and of course we became public and really exploded in growth and kind of the darlings of the industry. All of a sudden, the building we're in now here in Chicago, directly above us here is a little company called Groupon. And we're no longer the darlings in the building right now. I think Groupon has definitely taken the cake on that one. I believe they had a $5 billion offer, and now they're looking at a possible public offering here at somewhere in the neighborhood of $25 billion, only like 3 months after. The interesting thing is you can't really play in this because they're private right now, and I find it interesting because there's a huge marketplace right now that exists. Okay, that's completely private equity or private marketplace. And although there'll be some very large IPOs coming out, we believe here in the year to come, especially around the tech sector, they can't really be played by clients thus far. But it almost feels like the tech bubble back in 2000 did, in that when you get a valuation of $5 billion back in January, 3 months later they're talking about a valuation now of $25 billion. Things get a little bit out of control with that. Anyway, let's kind of jump to another caller here. Next caller is Paul from Boston. Question about IRAs. You there, Paul?
Yes. Hey there, Don. Question for you.
Yeah.
I don't know. I know next to nothing about options, but I've been listening from time to time to an infomercial emanating out of Fort Worth, Texas, and they talk about compounding your stock earnings using covered calls as a technique. Sure. And I've got a couple accounts. One's an IRA and one isn't. And I'm thinking, is this a reliable way for a newbie, a realistic way for a newbie to get in there and start generating some reliable returns?
You know, let's not look at returns. Let's look at more like income against stock. So, really all that covered calls do is enhance your stock position slightly. I mean, the bottom line is, no matter how much you learn about options, when it comes to covered calls, all you're really doing is selling premium against the stock. The bottom line is, you better be a damn good stock picker for covered calls to efficiently work. Really? I see people all the time, they're buying stocks specifically to sell covered calls, and that's typically not a good thing. It really isn't. So you're buying a stock because you think it's going to appreciate, not because you want to sell the call on there. And that's what, all too often I see seminars promoting that stuff too, and it's dangerous, but that being
because
said,
of the chance that the underlying could take a dive, and then you're in big time trouble.
People got hammered, absolutely hammered in covered calls over the years. And you should see in 2008, people just couldn't hold their positions anymore. Who wants to sell a covered call when the stock has gone down to, it's literally 50% of its original value? Or, you own something like Citigroup that went all the way from, in the 40s and into the 20s, and then, it's still sitting at, a couple of bucks. They're going to have to reverse split it here. And that's of course, the fear of the covered call. Pick good stocks. They're profitable trades. Now, ultimately, if you have an IRA and you already own some stocks in it, getting into options is a matter of learning to sell covered calls, and that's fantastic. I mean, it's one of the best ways to get a feel for how to trade options in this industry is to sell covered calls if you already own a couple of underlyings.
Yeah, I don't. I'm in cash.
If you're in cash, I would actually spend time learning about vertical spreads. If you really want to get in options, there's two primary strategies. Learn everything you can about vertical spreads and learn everything you can about calendar spreads. I mean, really, those are the two primary strategies that comprise the building blocks of everything you do in options. Covered calls are kind of encompassed in that. Covered calls are as easy as can be. You go out, you sell an out-of-the-money option, you're done. But if you really want to take the time, it's worthwhile. And there's a lot of classes out there. There's paid education. I mean, TD Ameritrade owns their own education firm. It's called Invest Tools. Give them a call. Give them a call. If you have an account with us, they even give you some credit towards the education over here. Or if you've got, cash that you're willing to bring over, they give you education credits towards it. I'm not an infomercial, but I understand that paying for education, cuts your learning curve, the time of that down. Where some of the stuff may take you 2 years to learn on your own, they can probably cut it down to a 3 or 4 day workshop and then a lot of study by yourself there. And I hope that helps out.
It does. Last question for you would be this. The vertical spreads, the calendar spreads, would I be prohibited from using those in a IRA? Do they allow you to do that?
At ThinkorSwim and TD Ameritrade, you can now trade option spreads inside of your IRA. That is not true of most major broker-dealers out there, but we do allow covered calls in there. We allow you to sell spreads, iron condors, butterflies, and calendar spreads. Pretty much any named defined risk option strategy is now allowed inside of your IRA.
Oh, that's big news to me. I appreciate knowing that.
Yeah, and that's almost brand new over at the TD Ameritrade side. We pushed for that hard when they bought ThinkorSwim. We were like, you guys got to have spreads in IRAs because, in essence, it's protecting you, and that's ultimately why we wanted spreads in the IRA. So defined risk is critical, and being able to trade options inside those IRAs is critical.
Oh, thanks. This is eye-opening stuff for me there, Don. I appreciate this.
Yeah, thanks a lot for calling in, Paul. And, hey, when you start to get through some of that options learning curve, give us a call back. We'd love to talk to you again.
Yeah, great. I will do this. Great.
All right.
All right, thanks, Val.
Yeah, thanks for calling. So only have a couple more minutes here to wrap up this particular show. And with that, again, looking at the markets, what have we done? Absolutely nothing since we started this show. Futures are still up about 9. NASDAQ futures up about 20. They haven't sold off, so Don is still sitting here in total pain. All right. Yeah, those NASDAQ futures really need to come down a little bit. It looked good this morning at the open, and then they just ripped the other way. So again, looking at a couple of the questions we've had here, most of the stuff that we're talking about, throughout the sessions that I've done here are really about premium selling techniques and more about probability. What you guys got to understand is what I just said a moment ago is absolutely true. Vertical spreads and calendar spreads, that is options trading. I mean, you walk into a class and somebody says, oh man, there's like 50 different option strategies and you have to have a tool for each, marketplace. And, the reality is there's singles and verticals and back ratios and collar synthetic combos and iron condors and, 1-3-2 ratioed butterflies and deep and wide 4-month 3-strike double diagonal straddle strangle swaps. Ooh, that's a really exciting one. But in the end, they're all just comprised of vertical spread and or calendar spreads. No matter how complex you get, an iron condor is just 2 vertical spreads. Calendar spread is a calendar spread. A diagonal is a calendar spread mixed and combined with a vertical spread. A double diagonal is twice the commissions. Ooh, very exciting. Double diagonal is just 2 calendars, 2 verticals embedded into one another. But ultimately, again, it's all some of the exact same stuff. Right now, if you're at home, you're trying to learn a little bit about this, you're a client of ThinkorSwim, take a look at some of your information layouts. Probability of expiring, critical to start to understand. It's a probability of an option being in the money by 1 penny or more come expiration. Start to learn a little bit about delta here and, of course, the strategies, verticals, and calendars. On top of that, on a day-to-day basis, if you guys do trade on a day-to-day basis, always keep an eye on these futures. Okay, these futures drive order flow for the marketplace. I know that, Apple is very exciting and you want to watch Apple all day, every day, but you got to keep your eye on the ball, and the ball is that futures market. Really, that'll help you a lot in the future. Anyway, with that, they're putting on the music on behalf of myself, TD Ameritrade, ThinkorSwim. Thank you guys very much for joining us, and I will be back next week for the Options Hour. Thank you guys very much for joining us, and bye-bye.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry